Hey, this is Mark, and you're welcome to AUTOSAYS. You know what's wild? Right now, at this very second, somewhere in America, two identical people are paying wildly different prices for the exact same car insurance, and neither of them has any idea why. Same car, same driving record, same zip code, but one's paying $300 more every 6 months. Sound fair? Yeah, didn't think so. If you've ever felt like car insurance companies are speaking a language designed specifically to confuse you, well, buckle up, because today we're pulling back the curtain on one of the most deliberately complicated systems in American commerce. And trust me, what you're about to discover will change how you see every insurance bill for the rest of your life. Before we dive into this rabbit hole, do me a favor and smash that like button, hit subscribe, and ring that bell, because this channel is all about exposing the truth behind the automotive industry, the stuff they don't want you to know. And I guarantee by the end of this video, you'll understand why insurance companies have spent billions keeping you in the dark. So here's where our story really begins, and it's not where you think. We need to go back to 1897, Massachusetts, a time when cars were still called horseless carriages, and most people thought they were a dangerous fad that would never catch on. That year, a man named Gilbert Loomis bought the first automobile insurance policy in American history. And get this, it cost him just $7.50 for $5,000 of liability coverage. $7.50. Let that sink in for a moment while you think about your last insurance bill. But here's the thing nobody tells you about that historic moment. Even back then, even at the very birth of car insurance, the system was already being designed to favor the house, to keep customers guessing, to make comparison shopping nearly impossible. The insurance companies learned something crucial in those early days, something that would shape the entire industry for the next century and change. Confusion is profitable. Incredibly, massively profitable. Now, you might be wondering, how did we get from $7 policies to the Byzantine nightmare we have today? Well, stick with me, because this gets fascinating. In the 1920s, as cars exploded in popularity, something interesting happened. Insurance companies realized they had a golden opportunity. See, every single American who wanted to drive legally would eventually need their product. It wasn't optional, it wasn't a luxury, it was mandatory, a captive market of millions. And unlike selling shoes or groceries where customers could easily compare prices and quality, insurance was abstract, confusing, packed with jargon that made people's eyes glaze over. The companies understood something psychological. When people don't understand something, they tend to just accept whatever they're told by someone who sounds authoritative. So the industry developed what I call the complexity advantage, deliberately making policies so convoluted, so filled with exceptions and subclauses and conditions that the average person would need a law degree just to understand what they were actually buying. And here's where it gets darker. During the Great Depression, when Americans were struggling to afford basic necessities, insurance companies didn't simplify their products to help people make informed choices, they actually made them more complicated, adding new categories of coverage, new types of exclusions, new ways to deny claims, all while jacking up prices and blaming it on increased risk. Think about that for a second. When people needed clarity most, when every dollar mattered desperately, the industry chose opacity. But wait, you're probably thinking, surely the government stepped in to regulate this, right? To protect consumers? Well, sort of. And that's where things get really interesting. And by interesting, I mean infuriating. After World War II, as America entered its golden age of automobiles, insurance regulation became a state-by-state patchwork, which meant companies could basically shop around for the most lenient regulatory environment. And here's the kicker. Many states allowed insurance companies to use something called file and use pricing, which meant insurers could change their rates without prior approval. They'd just file the new rates and start using them immediately. And if regulators had a problem, they could complain later, after customers had already been charged. Pretty convenient system, wouldn't you say? Now let's fast forward to today, because this is where your story really begins. You're sitting at your computer, trying to get a quote, and you start noticing something weird. You enter your information into 5 different websites, same car, same coverage limits, same everything, but the quotes you get back range from $1,200 a year to $2,800 a year. How is that possible? How can the same risk be valued so differently? Here's what they're not telling you. Modern insurance pricing uses something called algorithmic risk assessment, which sounds scientific and fair, but in reality, it's a black box designed to extract maximum profit from each individual customer based on hundreds of data points you never agreed to share. We're talking about your credit score, your education level, your job title, whether you're married or single, whether you rent or own your home, what time of day you typically drive, what websites you visit, what your purchasing patterns look like, even what kind of phone you use to request a quote. Yeah, you heard that right. Some studies have shown that people who quote shop on an iPhone get charged more than people using Android devices because the algorithm assumes iPhone users have more disposable income. Wild, isn't it? And here's something that'll really bake your noodle. Insurance companies buy your data from information brokers who compile dossiers on virtually every American, tracking everything from your grocery purchases to your social media activity, building detailed psychological profiles to determine not just how risky you are as a driver, but how much you're willing to pay before you'll bother shopping around. They know statistically that most people hate dealing with insurance so much that they'll tolerate significant price increases for years before finally getting fed up enough to switch companies, and they exploit that inertia mercilessly, raising your rates gradually, 5% here, 8% there, hoping you won't notice or won't care enough to spend 3 hours getting new quotes. But here's where the history lesson pays off and why understanding this matters to your wallet right now. See, the insurance industry has always operated on a fundamental principle that dates back to those earliest policies: information asymmetry. They know everything about you. They know everything about risk. They know everything about pricing, and they've spent over a century ensuring you know as little as possible. They use terms like comprehensive and collision and uninsured motorist coverage and personal injury protection, knowing that most people don't actually understand what these mean or how they differ, and they bury the important stuff, the exclusions, the limitations, the situations where they won't pay, in dense paragraphs of legal text that would make your eyes bleed if you actually tried to read it. Now, here's a question I want you to think about. Why do insurance companies spend billions on advertising, on those funny commercials with lizards and mayhem guys and helpful neighbors, when insurance is mandatory and everyone needs it anyway? The answer might surprise you. They're not really advertising to get new customers, they're advertising to make you feel comfortable, to build brand familiarity so that when you're overwhelmed by the complexity of choosing a policy, you'll just pick the company with the friendly mascot you've seen 1,000 times on TV. It's a psychological game, and they're playing it masterfully, while you're just trying to legally drive your car to work. So let's talk about the present moment, because understanding the past only matters if it helps you navigate today. Right now, in 2025, the car insurance industry in America is worth over $300 billion annually, and it's growing every single year, despite the fact that cars are getting safer, accidents are becoming less frequent, and technology should theoretically be making risk assessment more accurate and fair. So why are prices going up? Why are your premiums increasing even when you haven't had an accident or ticket in years? The answer is both simple and enraging: because they can. Because the system is designed not to provide you with fair protection at a reasonable price, but to maximize shareholder value by charging you the absolute maximum amount you'll tolerate. They've got teams of data scientists and behavioral economists working full-time to find that sweet spot, that price point where you'll grumble and complain, but ultimately just pay the bill, because dealing with insurance is such a miserable experience that switching feels worse than just accepting the increase. And here's something most people don't realize. Insurance companies actually want you to have small claims occasionally. Wait, what? Yeah, you heard me right. See, when you file a claim for a minor fender bender, something that costs them $800 to fix, they'll pay it without much hassle, but then they'll use that claim as justification to raise your rates by $300 or $400 a year for the next 3 to 5 years, meaning they'll collect back multiples of what they paid out, plus profit. It's a beautiful system if you're the insurance company. You take people's money for years while they don't have accidents, then when they finally need to use the coverage they've been paying for, you pay the claim, but turn around and punish them financially for years afterward. Heads they win, tails you lose. Now, I know what some of you are thinking, but Mark, insurance is a business. They need to make profit. They're taking on risk. And sure, that's true to an extent, but here's the thing that should make your blood boil. The average profit margin from major auto insurance companies ranges from 5 to 12%, which is actually healthy compared to most industries, yet they constantly claim they're barely scraping by, that they need to raise rates just to cover costs, that fraud and claims are eating into their bottom line. It's simply not true.
The big insurance companies are fantastically profitable, paying their CEOs tens of millions of dollars every year, while simultaneously telling you they need to charge you more because costs are going up. The math doesn't math, as the kids say. So here's where we get to the part you actually came for. What can you do about it?
How do you navigate this deliberately confusing system and avoid getting fleeced? First and most important, understand that loyalty to an insurance company is a sucker's bet. They're not loyal to you. Every single year, you should be shopping your policy, getting quotes from at least 5 different companies. And yes, I know it's annoying and time-consuming and feels like homework, but that hour or 2 of work can literally save you thousands of dollars. And here's a pro tip they don't want you to know. Insurance companies give their best rates to new customers, meaning the company you've been with faithfully for 10 years is almost certainly charging you more than they'd charge someone brand new walking in the door today. That's not loyalty, that's exploitation. So return the favor and show them exactly as much loyalty as they show you, which is 0. Second, understand what coverage you actually need versus what they're selling you. If you have an older car that's only worth $3,000 or $4,000, you probably don't need comprehensive and collision coverage because you're paying hundreds of dollars a year to insure an asset that isn't worth much to begin with. Do the math. If you're paying $600 a year for comp and collision on a car worth $3,000, after 5 years, you've paid as much in premiums as the car is worth, and that's before considering the deductible you'd have to pay if you actually filed a claim. Sometimes the smart play is to drop unnecessary coverage and self-insure, putting that money you're saving into an emergency fund instead. Third, and this is crucial, increase your deductibles. Most people keep their deductibles low, like $250 or $500, because they're afraid of having to pay a lot out of pocket if something happens. But here's the reality. You should never be filing a claim for small stuff anyway because of how it'll impact your rates. So you're essentially paying extra money every single month to protect yourself against a scenario you shouldn't be using your insurance for in the first place. Raise those deductibles to $1,000 or even $1,500 and watch your premiums drop significantly. Then take the money you're saving and put it in a savings account so if you do have a small accident, you've got the cash to cover the deductible without it hurting. The insurance companies hate this one simple trick, and that's how you know it's working. Now here's the final piece of this puzzle, the thing that really brings it all together. The car insurance system is built to confuse you, to make you feel powerless, to make you think you just have to accept whatever they tell you. But you don't. You have more power than they want you to believe. Every time you shop around, every time you question a rate increase, every time you drop unnecessary coverage or switch to a company offering better value, you're pushing back against a system designed to keep you passive and compliant. And when enough people start doing this, when enough consumers start treating insurance companies the way insurance companies treat consumers, as temporary business relationships based purely on value rather than loyalty, the whole dynamic shifts. They need us way more than we need any particular one of them. So here's my challenge to you. Don't just watch this video and forget about it. Take action. This week, this month at the latest, spend an hour bidding quotes from different companies, look at your current policy and really understand what you're paying for. Ask questions, push back, refuse to be confused into compliance. And if you found this video valuable, if learning the truth about how this system really works opened your eyes, then show some love by hitting that subscribe button and dropping a comment below telling me about your own insurance horror stories, because I read every single one, and your experiences help other viewers understand they're not alone in dealing with this madness. The auto industry is filled with secrets like this, systems designed to benefit corporations at your expense. And here at AUTOSAYS, we're committed to exposing all of it. So stick around because we're just getting started. Remember, knowledge is power, but only if you use it. Don't let them keep you in the dark. Thanks for watching, and I'll see you in the next one.